So why do new investors lose money? And you know what? Even if you've been investing for a while, you probably make these mistakes as well. So let's go ahead and talk about it. A very quick Google search will reveal that most day traders and people new to the stock market, they tend to lose their money. So why does this happen? Well, let's reveal it, little Timmy. Reason number one as to why new investors lose money, they apply a surface level understanding of valuation metrics to a company. As such, they'll reach a conclusion that a company is on sale based on their own subjective judgment. Just because a company's stock is cheap, it does not mean that it's undervalued. I feel like that ought to be on the receipt of your next meal at McDonald's. I think it's that important. You need to be reminded of that. Just because it's cheap does not mean that it's on sale. And not to rub salt into your butthole, this is just an example. If you are invested into Dime Brands Global, then I apologize. But I'm going to refer to Dime Brands, ticker symbol DIN, to prove a point. And if you don't know what Dime Brands is, it's the parent company behind Applebee's and IHOP. Around 9 years ago, Dime Brands used to trade for about $110 a share. Now they currently trade for about, $32 a share, roughly? So seeing the stock price go from $110 to 32, an investor could easily make the mistake of concluding that Dime Brands Global is undervalued, especially after they take into consideration the PE ratio being a single-digit number. It's a 5.4. My goodness gracious. And I'm sorry to fart in your face, but that does not mean that Applebee's is on discount. By the way, their food is trash. Their PE ratio is low, and their stock price is crushed because their future growth expectations are flat or decreasing from years prior. For instance, in 2009, during the Great Recession, Dine Brands posted $1.4 billion as their revenue. And just this past year, after we fast forward all these years, now they generated $831 million in revenue. So you're telling me during the Great Recession, Applebee's and IHOP did way better than they're doing right now? Needless to say, the company has been struggling for a while and the stock price is reflective of that trend. Reason number two as to why new investors lose money, they fall in love with yield traps. What does that mean? What's a yield trap? Looking at Dime Brands again as an example, right now, their dividend yield is really juicy at 6.3%. And as a dividend investor, on surface level, I'm not going to lie, that sounds pretty attractive. Until you learn that the company has been declining in most metrics and their total return for the past 10 years has been atrocious. So in the past 10 years, the total return for Dime Brands has been negative 42%. So all I'm trying to say is it worth losing your money to get a 6% dividend yield in a shaky company? Some people would argue yes, unfortunately, but as for me, it's a no-go. And the next reason as to why investors lose money is that emotions cloud their judgment and they make decisions based off of emotions. And the thing is, anybody can invest into stocks. You don't need an MBA or a CFA to make generational wealth in the stock market. Everyone is smart enough to do it, but not everyone has the stomach. Peter Lynch, one of the best investors of all time, said this, which I resonate with, and I may or may not have this quote printed out and decorated on my bathroom wall. He said, "I've always said, the key organ here isn't the brain, it's the stomach. When things start to decline, there are bad headlines in the papers and on television. Will you have the stomach for the market volatility and the broad-based pessimism that tends to come with it?" Thanks for that, Peter Lynch. So to combat against emotional decision making, have a game plan that is made with a reasonable and logical mindset. Don't make emotional decisions financially or in your personal life as well. If nothing fundamentally changed about a company's business and their operations, why allow a headline to strike fear into your heart so you do a panic sell for a loss? It makes no sense. The next reason as to why investors lose money is that they lack patience. Maybe someone told them that they could double their money overnight in the stock market or triple their money through trading options. But my friends, that's a losing game. There's more losers than winners when you day trade or invest for the short term. However, on the other hand, when you invest for the long run, you almost always come out on top. That is, if your investment is into a high quality dividend compounder with cheese. More on that here in a little bit. Stick with me. The sad sad reality is that some investors choose to lose money by panic selling after only a week because their investment goes on a short-term dip. When you do that, you miss out on the compound growth that happens over the long run. For example, I bought into 3M 2 years ago around September of 2022 for about $93 a share because based on my math and calculations, the company was undervalued despite the litigation hurdles they were going through. But after I bought into 3M, the company traded sideways and then it kept declining up until 2 weeks ago when the company posted good news and strong business forecasts. And now it currently trades for about $127 a share. So literally overnight, the stock price skyrocketed by 20%. So after roughly 2 years, now I'm in the green by about 35%. So by holding on, I was able to recover from the red. Now on the other hand, if it were a speculative startup company, then this would be a different story. But we are talking about 3M, which is one of the biggest industrial companies in the world that has products in many industries and fields. And don't even get me started on their intellectual property and patents. So if a good company, short-term dips do not freak me out. Case in point, check this out. Over the past 100 years, the annual rate of return has been 10% for the S&P 500, meaning your money would have grown on average by 10% year over year. And as you can see by the red spikes on the graph, yeah, the market does go down from time to time. However, slowly but surely, the market goes up, as indicated by the blue graphs. And that's why most people are better off by investing into VU or VTI, which are my most favorite index funds, and just calling it a day. That's the only two investments that you really need. But again, I want to reiterate that not all companies follow the market's trend. However, most of my investments tend to be in the S&P 500, and they tend to mirror the market's movement. So when we think about Procter & Gamble, Google, Home Depot, and even Target, when the markets are in the red because of a once-in-a-lifetime pandemic, these companies will also be in trouble. But when there's a bull market, these companies will usually rally as well. That is, of course, if their business model and economic moat stay in place, unlike your receding hairline. And a quick history lesson before we move on. In the year 711, I'm not making this up, in the year 711, Muslim armies from North Africa invaded, and in 7 years, they conquered the Iberian Peninsula, which includes Spain and Portugal. So Spain used to be a thriving Muslim country with a market for traders and was one of the richest countries in the world at the time. And funny enough, I could be wrong, but the Muslim rulers used to tax the living hell out of the Catholics and the Christians that lived in Spain unless they converted to Islam. So, most merchants and citizens of Spain became Muslim to reduce their tax burden, and that started the domino downfall since the country's finances were all wonky. They depended on the taxes that the non-Muslims were paying in order to finance a lot of projects and growth. And eventually, in 1492, Christian warriors banded together and reclaimed Spain as a Christian nation, which was known as the Reconquista. And you can go ahead and call me a redneck American, but I had no idea that this happened in Spain. So I think I just found my next historical deep dive, because for the past 3 months this year, I was nerding out over Native American history. So I'm pretty excited to learn more about the Crusades and the Moors War, and I just wanted to say, isn't life amazing? You never know what your next interest is going to be because there's so much wonderful music, movies, TV shows, hiking trails, and hobbies to get into. Unless you're into rubbing ice cubes on your nipples until they're hard enough to paint pictures of trees in your free time. If that's you, I don't know about that one, but life is wonderful because there's so many things to do and to check out and just so many different hobbies and interests to get into. The next reason investors lose money is because they follow the herd or hype. Just because everyone else is doing it, it does not make it a wise or sound investment choice. My rule of nipple that has served me well is to proceed with caution when everyone else is being greedy. The most recent example that I can think of are NFTs. Everyone on the internet, including their ex-wife's boyfriend, were talking about NFTs being the next big thing. For me though, I just don't think that they're worth the hype. And with that said, I'm about to reveal the last reason, and I wasn't so lucky. The most common reason, which is kind of like an expansion pack to the first reason, the reason why most investors lose money is because of speculative companies or business operations that have bad financial health. When I look back on my own life, every terrible mistake I've ever made is when I acted against my usual self and went against my values and principles. So during the pandemic, I actually invested into a very speculative agricultural technology company known as App Harvest. I got swept up in the SPAC frenzy fever and believed in the charismatic CEO. And their earnings presentations made it sound like it was going to be the next gold rush. The idea of making produce and vegetables that were weather resistant, pest resistant, and able to be grown in a warehouse environment. So I thought that was pretty cool and I invested into it. So fast forward a couple years, it turned out the executive leadership were misleading investors and throwing out false promises to how good their tomato operation was actually going. In reality, their business was losing cash like crazy, and eventually the company went bankrupt. And I'm not going to lie to you, when I lost that much money, it was a very devastating week for me. My mental health was obliterated, and that was a big lesson to me, and why I am so strict about a company's balance sheet now. And the thing is, this is what really bothers me. I talked about it a little bit, but prior to App Harvest, I was a dividend investor by heart, slow and steady, that patient investor. However, emotions got the best of me, and I experienced FOMO, and I invested into a very speculative company that went against my usual investing thesis. So that's why on this channel, I might be a 30-something-year-old, but I have a hatred towards speculative companies and growth investing in general. Because I'm hoping that people can learn from my mistake, that the slow and steady, tried and true dividend investing is truly the way to go. Alright, so with all of that said, then how do I avoid losing money in the stock market as an investor? Well, Billy, it's a lot easier than you think. I minimize my losses in the stock market by investing into high-quality dividend compounders that have an economic moat and an investing thesis that writes itself, meaning their metrics are growing year over year when we look at their revenue, net income, free cash flow, their earnings per share. And when I say high quality, it's pretty straightforward. Is the company running a solid business operation with a predictable income? Do they have little to no headwinds coming their way? And will they be business as usual despite macroeconomic conditions? Is this a product or service that people will need despite whatever craziness is happening around the world? And are they growing their dividend payment? Because a company that is able to afford and pay a dividend tells me a lot about the financial health of the company. And before I forget, is their total return at the market rate, or is it better than the S&P 500? Because total return is important for my calculation into a potential investment. Also, do they have a toll booth business model? I'm talking about companies that operate as a duopoly or oligopoly, meaning there's only like 2 or 3 or 4 companies in that entire industry and they have all of the market share. Companies that are here today and here tomorrow. When I ask myself questions like that before buying into a potential investment, it helps me to sleep at night, knowing that it's not going to be a risky investment. Although I do want to throw out the disclaimer that all investments have some element and degree of risk, but not all are as risky as shaving your balls in the shower. Because if we are going to be honest, your razor could do some serious damage to the scrotum if you're not careful, and that's how I think of speculative companies. Jokes aside, when you look at dividend compounders, there's not many of these companies around. I would argue there's probably maybe 100 to 150 of them in the stock market, and that range is pretty wide depending on how strict your evaluation is, and that's a good thing because it makes picking one from the bunch an easier decision. 100 really good companies to pick from rather than looking at all 9,000. So to sum it up, the best way for new investors not to lose money in the stock market is to pick and choose and invest into dividend compounders with cheese. And if you made it to this point in the video, I highly encourage you to watch my video, Essential Investing Tips I Would Share with a Family Friend. That video has really sound advice that I wish someone would have told me so that I didn't have to learn all of my investing lessons the hard way. Anyways, I hope you enjoyed this one. I love you. Stay safe, and I'll talk to you next time. Bye-bye.